if you're hoarding any cash, at least make sure it's working for you. Because I've seen so many times where I'm catching up with the clients and I'm like, oh, okay, they must have got in cash, 50 or 100K. I'm like, oh, what's the name of the account? And they got it sitting in a transaction account, giving them no more than probably 1% at best. And that interest is still taxed. So you take away at least a third or possibly even nearly 50% if you're in the highest tax bracket. What's your one from your order of preference there? Like if someone has an offset, that means they've got a mortgage. What's your most to least preferred if they've got a mortgage?
It's almost always the offset account. You know, a variable rate mortgage is always going to have a higher interest rate than anything you can get in a savings account or a term deposit. But the kicker is
Welcome back to the Winner's Playbook. Josh here with Billy. If you have cash sitting in the bank, this episode is for you. We will run through easy ways to make your savings work harder without taking silly risks. Think high interest accounts, term deposits, offsets, and simple cash funds. By then, you will know where your cash belongs and how to set it up in the next few steps. But before we dive into the detail, Billy, what's the latest in your life, mate? And what's happening? It's a really good weather today, actually, in Melbourne. So it's very much enjoying that.
Yeah, I wouldn't know, mate. I'm locked up in the office here, but I am getting out tonight, a little date night with my wife, which, as you know, becomes harder once you have kids and all that stuff.
Non-existent.
Non-existent, yeah. No, we're making a bit more of an effort.
Yeah.
So my mom's coming over to babysit, and we're heading out to see. We're both heavy metal fans, and that's actually one of the ways we met. It was like a mutual interest. So we're going to see a band called Opeth. They're a Swedish death metal band that we both love, and they're playing down in St Kilda.
Cool.
And we're going to check out the Espy before that, which we realised our second date was at the Espy, which was like 10 years ago. Haven't been back there since. So we thought we'd have a little nostalgic beer there and then go to the show. So
what a trip down memory lane. I think I think I only went to the Espy once in my life, and it was a couple of years ago. We were stopping through, and we had a couple of drinks there. But is the line there? It's a pretty busy venue, isn't it? I
haven't been there for 10 years. I hope.
Yeah, we're trying to get in there. It was the Full of the Young'uns last. Well, that was on a nice sort of summer day on a weekend. But we'll be keen to find out how that goes next week for you, Billy, and we'll see how that one goes. But no, that's good. Well, I'm not going to any sort of heavy metal gig tonight. That's for sure. I'm not going down that way of town. But the week's been pretty good. We had Leon's first birthday last week, even though his birthday was a couple of weeks prior to it. But that went off without a hitch, which was good. Did I tell you what I got him for his birthday yet, Billy? Did I tell you that?
I don't think so. Well, what did you?
It was quite funny because I was unsure of what to get him, and obviously Alana's got him a few toys and things, and I was like, what do I get him? Like, he's not going to ever remember this either, but how can I try and make this memorable? So what would you be your guess? What would a financial advisor get their firstborn son?
Oh, no, you didn't set him up with a savings account, did you? Investment bond.
Oh, no, he's already got an investment bond. He's already got one of those, but I went a step further.
Cash register. Little cash register.
I got him a little gold bullion. I got him a little gold bullion. So the price had obviously skyrocketed lately, but it come off a bit, and I bought an ounce of gold bullion. So that's that was his first present from me, and I'm planning to do that every child, I reckon. We'll see what happens to the gold price, but we'll stash that away in a safe, and maybe it's worth a lot of money when he's a bit older. So he'll probably have a good laugh about that when he could understand a few more things. When he's a bit old, but it was quite funny, that one. But other than that,
hope you've got good security at your place where he's staying.
Yeah, well, we got the big dog, we've got gates, we've got cameras, so I don't know what much more we need than that. But you can never be too safe these days, of course. And around the house, because the weather's getting a bit better, we've got a bunch of veggies planted out at the moment. I've got like a little tomato farm growing right now. I threw a bunch of seeds in a few pots, maybe a couple of months back. They're probably all about 1/2 meter, but I want to have a crack at building a bit of a planter box tomorrow. I've got a lot of timbers left over from some decking that we ripped up from some renovations that we were doing outside. And I got a heap of these little timbers left over. So I've got a bunch of tools, and I'm not the most handy guy on my own. So I'm going to have a crack at building a little planter box. Maybe I'll put it on TikTok so everyone can see the actual results of it. But yeah, hopefully I don't lop off a thumb, and I'll be in the office with all my fingers on Monday. So that'll be interesting. It's quite soothing. I won't lie. Doing gardening. I don't know about you, Billy, but I don't know if that's like all guys, but I find there's something in doing a bit of gardening and growing some plants. I don't know if you've ever been into it, but yeah, I'm finding a bit of fun in that.
Well, a skeptical person would say you're just trying to get away from the noises that children say.
There's probably something to that. There's probably something. It's true. It's my that's my sort of downtime. That's my only bit of downtime between the family, the businesses, and seeing clients. Just a bit of quietness, planting some trees. So that's my I guess that's my escape. Besides the 4:30 gym sessions, that's probably another escape at the same time. Very, very, very different, those ones. But no, we've got a good topic to obviously talk about today. Quite relevant considering today's environment. Interest rates were on the way down, and they look to have sort of stalled here a little bit. And markets beginning to shake. God, have you seen crypto? Crypto's come off a lot in the last couple of months. I think Bitcoin's down at about 130 Australian dollars, and it was up around 190-ish, I think, a couple of months back. So crypto has fallen off a cliff. Financial markets, though, still holding up pretty resiliently. And you're seeing the I don't know if you were looking at it yesterday, Billy, we had up on the screen the office NVIDIA earnings come out, and done, I think they were up by 5 or 6% shortly thereafter. So yeah, financial markets still pretty buoyant, all things considering. What are your thoughts?
I've heard that phrase that markets can go up. They go up the elevator, up the stairs, or up the escalator and down by the elevator.
Yeah,
I think it's like, look at the Aussie share market. It pretty much wiped out a year of gains in like 3 weeks.
Yeah,
that's how it can happen, and that's why investing's so hard, because you get complacent. Like, oh yeah, markets are great. I'm making 10-15% a year, and then the whole thing can get in 3 weeks. You can lose your 15%.
yeah.
So there's a bit of that going on the last few weeks, but we'll see. And it can often happen heading into Christmas too. I think a few fund managers just think, oh, I don't want to, go away for 3 weeks and then come back and find that the market's dropped. So I'll just do a bit of selling, a bit of profit taking now before we head off for the break.
Yeah.
But nothing seems to have fundamentally changed from what I can see. So I don't think there's too much reason to be particularly fearful at the moment.
Well, not if you're investing longer term anyway, but I suppose if you're trying to stay the day-to-day in trading, you probably have a little bit of fun amongst that. But yeah, crypto, a bit of a bloodbath at this point in time, but I'm sure it will come roaring back at some point in time, like it always does, driven by, I don't really know sometimes what's actually driving. I think a lot of it really is like a bit of like momentum. And, now a lot of people are seeing that red and they're selling for no better reason. There's obviously a lot of leverage in crypto as well, and there'd be a lot of leverage positions probably coming off and people being forced to sell their positions, I think, and that's why you've seen a bit of a rapid sort of drop on the crypto side of things. But yeah, we won't dive into too much of that today. Maybe another topic for another time, because we're going to be talking about something very different, which is around cash and cash buffers. Yeah, what's your place and where do you put cash in the whole scheme of things, Billy? What's the purposes of it? Why do we need it?
Yeah, when planning out for clients, a lot of people do not have their cash set at the right levels. Like, there's obviously the emergency fund, which I'm sure almost everyone listening was thinking we'll talk about emergency funds. That's an obvious one, right? What if something goes wrong, unexpected expenses, someone loses a job? You want to have at least a few months of cash sitting there. But over and above that, where people don't often factor these things in is like cash for specific future expenses. Might even be something that's a year or two off that you're going to have to pay for. You want to factor that into your cash plan. And then probably the big one, which is common, is if you're saving for a property, right, and you've got to come up with that deposit. Ideally, you're doing that with cash. You're building up cash for that purpose. The last note there is like retirees should generally have a lot more cash because they're actually drawing down on their money. So you want a lot more cash there, particularly if markets, go through a period where they're really volatile. Helps you sleep at night knowing you got plenty of cash sitting in the bank.
Yeah, good point, and that's a really good one for retirees because yeah, it's a part of why we tend to position retiree portfolios in a bit more of a moderately defensive manner, where they might hold 40 or 50% of their assets in more defensive traditional assets like your bonds, cash type assets, term deposits, whatever it may be. So when the markets get a little bit turbulent, you're not forcing to be selling down on your shares and your growth assets when the markets are dropping, because that's when you can sort of start crystallizing in those losses. So very, very relevant for retirees. But yeah, I think you sort of nailed it there, Billion. Pretty straightforward. It really just comes down to like your goals and what you're trying to do. Like if you're going to be buying a home in a couple of years, putting all your savings towards the share market, although it could yield a better return if you get lucky, you're kind of gambling there in a little bit of a way over a short period of time, whether or not that's going to give you a better financial outcome, as opposed to just sticking it in a high interest saver or some sort of safe type structure like that, which is definitely going to give you a lower rate of return, but at least you have the guarantee that your money will actually be there when you require it, as opposed to you stick it in the share market and you get unlucky and the market drops 5, 10, 15 or 20% or more in the period of time or when you ultimately require those funds. So yeah, cash definitely has its place in the portfolio, and your buffer, your bills, car breaks down and having it there. So I suppose that sort of falls part of your emergency fund. But I think the biggest thing is, like I always try to make clear with my clients as well, is making sure that cash is always, if you're hoarding any cash, at least make sure it's working for you. Because I've seen so many times where I'm catching up with the clients and I'm like, oh, okay, how much we got in cash? 50 or 100K. I'm like, oh, what's the name of the account? And they got it sitting in a transaction account, giving them no more than probably 1% at best. And that interest is still taxed. So you take away at least a third or possibly even nearly 50% if you're in the highest tax bracket to taxes, and it virtually leaves you nothing. So I'm very, very active around that one with clients in terms of making sure, at least if you've got any cash, at least make sure it is working as hard as it possibly can, which then goes into kind of where do we put cash, Billy, and the differences between like a high interest saver, term deposit, and an offset, and how they sort of stack up compared to each other. What's your one from your order of preference there? Like if someone has an offset, that means they've got a mortgage. In terms of like where someone generally should be putting cash, of course, not advice. We don't know anyone's situation here listening, but in terms of offset, high interest saver, term deposit, what's your most to least preferred if they've got a mortgage?
Oh, it's almost always the offset account. A variable rate mortgage is always going to have a higher interest rate than anything you can get in a savings account or a term deposit.
Yeah.
But the kicker is, if you have money in a term deposit or a savings account, the interest that is generated is taxable income, goes into your tax return.
Mm-hmm.
So if you're working full time and you've got some interest on your savings, you're going to pay tax on that interest. So if you're earning a 4% interest rate, after tax, it might only be less than 3%. Whereas these days in a mortgage, looking at current rates, your home loan rate might be 5.5%. So if you use an offset account, you're essentially getting a 5.5% guaranteed tax-free return versus, 2 point something percent after tax in a savings account.
Yeah. So the offset's obviously the clear winner on the assumption you have a mortgage. But what about high interest accounts and term deposits? What do you look at there, and why would you use one or the other?
If you don't mind doing a little bit of research and fiddling around with bank accounts, then online savings accounts, generally you can get better rates there than you can in term deposits.
Yeah.
Part of this is like when we're, at a point in time, things are changing. Right? Term deposit rates move all the time. Savings account rates move. But these days, usually you're getting a better rate in your top online savings accounts than what you get in term deposits. Plus you have more flexibility. Term deposits are locked up. Savings accounts are not.
Yeah. Yeah. And if you look at some of the
what have you
main
seen in savings accounts and TDs?
Yeah, no, I 100% agree with that. I guess the term deposit gives you more certainty because you can like go 1 year, I want to lock in that rate of interest, and you get that, because if you're in a high interest saver, obviously it's a variable rate, so it's going to be moving around. I was just having a bit of a look around before we hopped on here in terms of some of the term deposit rates. It's quite interesting to look at some of that, because if you look at some of the bigger players out there, like NAB, ANZ, AMP, Adelaide Bank, if you're looking on the 1 year, the best I can see is about 4.2%. but you can still get high interest savers, like you were saying. Like everyone always knows the ING Savings Maximizer. It's probably one of the most known savings accounts around in Australia, and I believe that that's still paying 4.75%. Now, you can only have a maximum amount of money into it, $100,000, and there are some steps you have to meet to keep that rate of interest. So it's not, again, like to a term deposit where you just put your money in and you can just sort of forget about it and you're guaranteed going to get the interest. But there's a few more little steps there to get that on ING. But then you've got the flexibility of access to that money at any point in time. Whereas some term deposit providers, if you want to draw out early, you can actually forego, in some situations, all of the interest that's accrued at that point. So generally, if you've got the term deposit, you're looking at, I'm trying to think if in the last couple of years, have I even used it for an accumulator? I can't think of one. It's generally going to be more
retirees.
Yeah, retirees who've got some cash and they want to park it and lock it away for 3, 6 or 12 months. And we just want certainty on that steady income. And I think the other point to mention with that one as well is, the term deposit rates are actually under that of the high interest savers. So if you want the best rate of return, well, a high interest saver is probably the consideration. But the thing to look at there is like a lot of the high interest savers have these like bonus introductory rates that you got to be a little bit careful around. So I don't know if you've seen some of those, Billy, but sometimes I've seen clients, they get tripped up and they get this high rate, and then 4 or 5 months later, it falls off a cliff. Have you seen a few of those?
Yes. Yeah, absolutely. ING are the worst at this these days. They used to have the best offer for a savings account. They definitely don't now. Like the rate's really good, but the amount of conditions on it is,
And then if you miss,
they're relying on people stuffing it up. That's where they make their money.
sure.
Because you have to add money into that savings account every month. If there's 1 month where you don't add to it, they'll pay you bugger all interest for that whole month.
Yeah. Is it 0.5?
Yeah, it's like 0.5. Yeah, like if you take some money out of that savings account on the 29th of the month, then for that entire month, they're only going to give you 0.5%.
Yeah.
So they're a bit, and you've got to use their daily banking as well to qualify for the bonus rate.
Yeah.
Yeah, so they're a bit tough. And I know you probably agree with me. Macquarie's the best in this space at the moment.
Yeah, no strings attached, just a straight savings account. Yeah, and I think they've got a good balance on it, not capped at 100K. I think is that up to 250 or so, and then so there's no strings attached. That's where you definitely got to look at those T's and C's on the high interest savers, because you can quite easily miss out, and there's all these hoops that you've got to jump through to be able to get the rate of interest. But yeah, even those bonus introductory rates, it's like the headline looks like it's really good, and then, it's like that honeymoon period. You go through the 3 or 4 months, they're giving you 5%, and then it reverts back to their nominal rate, which is a hell of a lot lower than it. So yeah, you definitely got to be very careful around those, but it doesn't hurt. If you didn't have an offset account, well, then having a high interest saver is always something I do with my clients. So in terms of having one account, your primary account where you're going to pull up cash, that can be where the high interest saver comes in. But what about some alternatives, Billy? Because we don't just look at those for clients that have got cash needs or more shorter term needs. There's obviously some other products around, ones that we do recommend from time to time, like Latrobe. Everyone's usually heard of Latrobe as a 12-month term account. Do you want to touch on a bit of the differences there? Because that's not a risk-free play like a term deposit or a high interest saver, but it does obviously offer a high rate of return for it. Do you want to just touch lightly on that one?
Yeah, well, we'll be careful here because Latrobe have been in trouble with the regulator for comparing themselves to term deposits.
They have.
So we're not comparing them to a term deposit.
We're not. Certainly not.
We're not. And they've sort of marketed themselves a bit that way in the past, which got them in trouble. But to their credit, that Latrobe fund, that's been going since 2004 or something.
Yeah.
Even through the global financial crisis and everything else that's happened, you've never lost a cent of capital. So if you invested 100 grand in Latrobe, let's say right at the start, you'd still have 100 grand today. Like it never fluctuates. They've just managed to just pay that interest every month.
Yeah.
Without any fluctuation. So it has behaved like a term deposit.
I like
but there is, with a term deposit, there's a government guarantee on your money if you buy a term deposit with one of the major banks.
Yeah.
Worst case scenario, and that bank goes under or something, the government's guaranteeing you'll get your money back.
Yeah.
Whereas Latrobe, that's like an investment. Like the Latrobe fund is being used to create mortgages, and that's how they're generating your return. So if there was if a lot of people started defaulting on their loans, then you can lose your money. There's no government guarantees or anything like that. So you're taking a bit more risk, and they're rewarding you for that. They're paying, was it 6% at the moment? And that if you do Latrobe through a financial advisor, they give you a little bonus. So it's 6.5%.
Yeah.
So you could get a bit of a premium.
Could you touch on, Billy, because you've been in industry for longer than I am, and I remember when I joined the industry around 2017, I remember looking at some clients' portfolios and seeing some property funds they had in there that had been frozen for over 5 years, and they couldn't access any of that money. Could you maybe touch a little bit on that? Because I see sometimes clients, they get nearly get sucked into these legitimate investments and that are providing them, but they're offering sometimes like 8, 9, 10% plus, and people think that it's like a guaranteed and it's risk free. There's no risk. They can get their money out whenever they want. But I'm sure you've seen it. So can you touch a little bit about like what can happen in those situations and how your funds can get frozen? And because I'm sure you've seen that a few times over your career.
Yeah. The GFC was a big one, but it happened again through the COVID sort of period. All these funds that are offering you, we pay income of 8%, we pay income of 9.9%. There's always risk. Like as soon as you try and get a better return over and above a savings account or return deposit, there are risks. And it's hard to see that sometimes because those funds that are paying you 8%, 9%, it might be smooth sailing for 5 years, 6 years, 7 years, 8 years. It just takes one event like a GFC, like a COVID crisis. Like it takes one event. If too many investors try and sell at the same time, it's not cash. Like the product provider isn't just sitting on cash. They're ready to pay everyone out at the same time. So when those events happen, either you can lose money, you can lose capital, or you can just be told, no, you can't have your money. We don't have it. Everyone's trying to sell at the same time. You're going to have to wait. And sometimes that wait is years. And an example of one of those sorts of products is just like a direct property fund. So you're investing in a fund, they're buying 10 office buildings, right? Like commercial properties. If too many people try and sell at the same time, well, it can take years to sell an office building.
Yes.
And if they're forced sales, they're probably not going to get a good price. Like if everyone's trying to sell at the same time. Anytime you see a return above 5%, it's not guaranteed. Pretty much, it's the lesson.
You got to look a bit deeper into what you're actually going into if that's the case, because yes, obviously a lot of risks you've obviously got to be aware of. But in terms of talking about cash in general, like when we talk about cash, we're talking about always having it in an actual account. Do you come across too often, people hoarding actual hard cash? Do you see that these days too often?
Yeah,
they probably wouldn't tell you, I suppose, if they were. So.
Exactly, that's what I was going to say. You would have seen it too. It's when you're going through our fact finding process. Like, okay, let's go through your list of assets. Right, you've got cars, you've got a house, you've got etc. And when you say cash, they'll say, "Oh, you have $5,000." Sometimes they'll say, "Oh, I've got some." Nah, don't worry about it. I've got some other cash. Oh, sorry.
Oh, that's just a little Leon has come back here. Yeah, I'm on it. Oh, sorry.
Bring him up to the microphone. I know he's leaving.
You doing, Leon?
Here he is. Hi, Leon.
Say hello. Leon's debut into the podcast. That's what we just had. He's just done a debut. Where was I at? I was actually to say
cash. Yeah, so people do have cash. They often don't tell you or they hint at it. I've got to go into prospects for gold.
Oh yeah, that's quite fun.
He's actually he's made a few $1,000 just finding gold, which is pretty cool. He won't tell me where though. He won't say where.
Right. Side story quickly on that one. My family had a little farm up near Shepparton in a town called Rushworth, and we bought that. Early 2000s. It was 20 acres, so we used to go up there every weekend. And I was actually addicted to hunting gold when I was younger. I was so obsessed with it. So I bought a little metal detector. And so the actual town itself, the story is the way I understand it is it's called Rushworth, and that was going way back in time when there was the gold rush to was it Bendigo or Ballarat, when there was all the gold rush happening down in Victoria, and Rushworth like got the name because it was like worth the rush. So that to the town, there was a lot of gold that was found. And when we were there, it was very often in the local newspaper, people would be finding these old like gold nuggets in dried up dams and so on and so forth. So I was always out with my little metal detector when I was a kid trying to find any gold, and I didn't get any. But we actually we dug a few big holes at one point. My brother did it when we were a little bit older and had the excavator dug down, and we set up a little sluice and we actually found a little bit of gold. So
Wait, you had an actual excavator? Yeah.
like my brother had one up there. Yeah, he had one, and we dug down. We set up one of those little sluices where you sort of put the all of the dirt and so on in at the top. It runs down through these little ripples, and yeah, we genuinely were finding a bit of gold. So anyway, we just went off on a little bit of a tangent there. What I was going to say though is around the cash one is interesting, because I've sometimes seen retirees in the lead up to retirement pull funds out of accounts, and I don't question it, but I'm certain, and we've all probably got retirees that are hoarding some cash on the side, of which Centrelink probably is not any part aware of, because they're trying to get more of an age pension. So I'm 100% certain there are a lot of Australian retirees that are adopting that strategy, which is not one your advisor's typically going to tell you about, but no one's going to stop you doing whatever you want with your money. I do definitely tend to see the older generations to be the ones holding on to a bit more cash, as opposed to, this cashless society we have these days. Your phone's pretty much, you tap and go and off you go. So I don't know, do you ever carry around cash, Billy, these days, or?
No, there might be $100 in the wallet, but it's the same $100 that's been there for about 3 months, I think.
Yeah. No, I'm 100% the same. What about splitting up cash across accounts? How do you tend to approach that with clients in like different banks and transaction versus like high interest saver? Do you have a general sort of rule in how you approach that with clients when setting up a cash structure?
I'll just split it up based on its purpose.
Yeah.
Like if you've got cash that's for a specific goal, like a property purchase, you might keep that separate from, let's say, cash that's building up for, an annual holiday or something. It's nice to keep it separate and labeled, just psychologically, to know what that money's for.
Yeah.
And also to motivate you not to spend it.
Yeah, very true. And that's
I think then it's just what we spoke about before. Offset accounts are usually the best go-to for the majority of your cash. But sometimes you might like to have an emergency fund that's really just a different bank in a savings account over there, so you're not tempted to touch it or play with it.
That's a big one. The tempting to touch is a big one for the forced saving. I've got a couple of clients, I just caught up with one recently, whereby if any money sits in an account and they can see it, they will touch it. So we've actually had to, through their investment account, set up their regular investment contribution, but at the same time, let's just say the figure's 10 grand a month because they're earning good income. Say they're investing 5 grand a month and saving 5 grand a month. We're actually putting 10 grand a month to their investment account and putting 5K to the investments and 5K in the cash account, because the investment account's kind of like, although it's there and they can access it if they want, it's like another few steps out of mind and out of sight. So they actually do save. Whereas if they tell me if they keep it in the savings account, they're going to spend it. So
I actually have to through you. And so the shame of something. Yeah, we did. I wouldn't, but can you?
We need money. So
help us with the withdrawal. Yeah.
Something to be said in that. There's very, very much something to be said in that. But I think that the general rules are, have a purpose for your accounts. You can go on there and name them. That's what you definitely want to do. Like, go on there and name them. If you've got your bills account, your everyday transaction account, your mortgage, your savings, whatever it may be, separate them out. Always worth of noting, if you've got an offset account, a lot of the banks are getting a bit better at having unlimited offset capability. So I've just seen, I've got some loans with Westpac. They just came out with it in the last year, where you can attach unlimited amounts of offset accounts to your home loans without additional cost. Whereas previously, most banks, if you tried to do another offset, you had to pay extra fees to have those offset accounts. So yeah, I've got quite a lot of clients now where we set out all of their different accounts and we actually make them all offset. So every account's pretty much working as optimally and as hard as we can for them, as opposed to having one central offset to hold most of the cash, and then all of the other ones are just transaction accounts, or maybe there's just one high interest saver in there. But obviously only relevant for you if you do have a mortgage. If you didn't have a mortgage, that one's not relevant for you. And in closing, Billy, one simple rule to review rates without chasing every promo. What's your tip there?
I like choosing a bank that is consistently competitive and simple. So at the moment, as we discussed, that is Macquarie. In the past, that might have been ING, but generally speaking, unless you're really keen to be checking your rates every month and moving banks all the time, if you just want to keep it simple, just choose one of those major banks that's got, in recent history, they're competitive and they don't impose all these conditions on you.
Yeah.
If you still need to, like everything to do with your finances, you still want to review it, sort of at least annually. But yeah, that's the main thing, I think.
Yeah, agree. And I don't think it needs to get any more complicated than that. So I think if you're banking across multiple banks, things do start to get a little bit messy and a little bit complicated. And I do tend to see sometimes where people have refinanced over to new banks, but they keep all of their previous bank accounts with the previous bank that they had, and then they get new accounts set up. And people I've seen 10, 15 accounts with clients all over the place. So you definitely want to stay on top of it, because it's kind of like having a bit of a messy desk or a messy yard. It can kind of mess with your psyche a little bit there if you've got accounts all over the place and just simplifying it. So, ideally, if you can have it all there within the one bank, and maybe you just have assuming there's a good high interest saver there. But generally, most banks are pretty competitive. Opening up multiple accounts is really easy. You can do that at just tapping on your phone within a few minutes. So very much agree to that. But other than that, Billy, I think we'll close out. Good podcast talking around cash and a few other personal stories in there as well, which is always good. So if you're getting value out of it, guys, please give us 5 stars on Spotify and Apple. We're actually going to be moving into a new office, of which is ours now, but we move in about February, March next year. And we're going to really revamp the podcast at that point in time and have a podcast studio. So it's all going to probably look a hell of a lot more crisp at that point in time, and probably sound a little bit more crisp. And the podcast is going to get a big overhaul in 2026. So very much looking forward to it. But between now and then, hope you're getting value out of it. And if you've ever needing any advice whatsoever, please feel free to jump on the website, take a look at any of the advisors, and book in for a free 15-minute call to have a chat about your personal situation. But until next time, Billy, enjoy the heavy metal concert, mate, and look forward to hearing about it next week.
Cheers. All right. Good luck with your planner box.
Thanks, mate.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.